Today we'll answer the question, why does the death benefit drop in my whole life insurance policy after 7 years? We see this with a lot of whole life insurance policies. Now we typically see this when someone is interested in a whole life insurance policy specifically for the cash value. When we look at the cash value, it is a safe place we can put money, meaning it continues to grow over the years without any market risk. It's very liquid. I can access it anytime, a lot like a personal line of credit because my money keeps on compounding when I access it. And then here's the big one, it's tax-free if we follow IRS rules. Now, one way we could mess a policy up and get rid of the tax-free benefit is if our life insurance policy becomes classified as what is called a modified endowment contract, or a MEC. If this happens, the cash value in your policy still grows tax deferred. But if you ever access the cash value in a policy that has become a MEC, you have to pay ordinary income tax only on the gains. And if you're under the age of 59 and a half, guess what? You got to pay a 10% penalty tax, which is not fun. So how we prevent this from occurring is that every policy has what is called a MEC limit. Now, the MEC limit is the maximum dollar amount I can pay into a policy per year and still keep the tax-free benefit that life insurance carries. So, lesson, I do not want to pay more money into the policy than whatever the MEC limit is. Now, the MEC limit is determined by my age and death benefit on that life insurance policy. Two other factors that do have an impact on the MEC limit is the guaranteed cash value interest rate with the product that I purchase, and then also my gender. That'll have an impact as well. But the major factors are my age and death benefit. The cool thing is we can always set that MEC limit wherever we want. We'll do that when we work with people and customize that MEC limit. Now, here's the key on this, which will start to answer this question, why does the death benefit drop after the 7th year? The MEC limit is also referred to as a 7-pay test. What does that mean? Well, the number 7 is significant. The 7-pay test has to do with the first 7 years of a whole life insurance policy. Now, it's not just the first 7 years, but when I start a policy, I'm focusing on the first 7. It continues indefinitely, but it's heaviest during the first 7 years. And that's what we'll focus on to answer this question, why does the death benefit drop after 7 years? So, here's the key. If I reduce the death benefit during the first 7 years of a policy, in most cases, I'll trigger a MEC. Why I would reduce the death benefit, why you see that a lot of times where after the 7th year we reduce the death benefit or that term insurance piece we have falls off, is because reducing the death benefit reduces the costs. So it allows our cash value to grow at a faster pace. When someone is interested in a whole life insurance policy for cash value, the name of the game is push the costs as low as we can possibly push them per the insurance company limits and also the IRS rules, and maximize the cash value. That's what people are interested in. That's exactly what we do for corporations, so we do the same thing for individuals. Now, when we look at dropping the death benefit after the 7th year, the thing about this is after the 7th year, because of that 7-year or 7-pay test, this is the earliest we can drop the death benefit without causing a MEC. So if I drop the death benefit at year 8, I won't trigger a MEC, and we keep it tax-free, which is nice. There's an exception to this. If I'm funding more than 7 years, and I'm specifically still adding money to my paid-up additions rider, then we would not want to drop the death benefit yet. We usually do that after we are done funding the policy or if we are reducing the funding amount. Let's take a look at a couple examples here. We'll look at examples of not dropping the term rider versus dropping the term rider. So what we'll start with is a whole life insurance policy. This is the baseline of what we're going to use. We have no term insurance rider here. This is just a $25,000 whole life death benefit. Costs us an annual premium of $530 per year. Now, with this policy, it does not have a $5,000 MEC limit. The most we could pay into this would be between $1,000 and $1,500 per year. Not that much at all. So what we do in this example is increase it, or I should say we add a term insurance rider to increase the MEC limit and pay more money into the policy. It gives me a permission slip to do so. So here, we've got the same $500 minimum premium. When we look at the death benefit, it's $250,000. So that minimum premium of $530 buys me the $25,000 whole life death benefit. And then here, we have a term insurance rider. Here we go. There's the cost of the term rider. So my minimum commitment would be those two combined if this was my policy and I'm 40 years old. What we're going to fund in this example, though, is $5,000 per year. And we're going to look at a very short funding period because a lot of people are attracted to this of 5 years. $5,000 per year for 5 years is a total of $25,000. And look at that. That's your break-even point between years 4 and 5. With this example, we're not going to drop the term rider. So what this means is look at your death benefit over here. It's at $250. Look at your term insurance rider here. Day 0, before you pay anything, it's $225. As you add money to the policy, particularly toward PUAs, it builds cash value, but it also pushes your whole life death benefit up. And as your whole life death benefit goes up, your term rider comes down, which is pretty cool. Now, some term riders are level. This is called a 1-year term rider, which will always balance out wherever we set the net death benefit. The whole life plus the term will be the number that we set. In this example, $250K. So if we scroll down here, you'll notice that that death benefit stays at $250, and we pay nothing into the policy after the 5th year. Versus the exact same policy. So look at year 5, your cash value is $25,420. Look at this guy. Year 5, your cash value, $25,440. Exactly the same initially. What's the difference here? Here's the question. Why does my death benefit drop after the 7th year? Because it's the earliest we can drop it to reduce the cost and allow my cash value to grow at a faster pace. What's the actual difference, though, in cash value performance? Because I do give something up here. I see a significantly reduced death benefit. If I care about the death benefit, I might not want to do that. You can partially reduce it too, by the way. It's not all or nothing. We could cut it down to 200, 150, whatever you want, and you could do that multiple times. But if I care about it, I might not reduce it. If I say, I don't care, that's where I might reduce it because it gives me more cash value. Let's look at a side-by-side comparison, shall we? This will be cool to see. What we have first is the example where we did not drop the term insurance rider. So before our age of 40, this blank column, you see your whole life death benefit, term rider, net death benefit at $250. Okay. He funds $5,000 per year for 5 years and then pays nothing. By age 60, down here at the bottom, he's paid $25,000. He has $41,000 in cash value, and the death benefit's still at $240. Look at this. What do you notice here? Same policy. The difference is we dropped the term insurance rider. At 20 down here, or I should say at age 60, year 21, paid the same in, $25,000. You've got $50,000 in cash value instead of 41 or 42. It's an $8,000 difference. And he paid in a total of 25. So $8,000 is significant. The same thing would be true if we made that $50,000 or $500K per year. A lot of times we'll see individuals still cut the term that are interested in the cash value. However, we look at these figures so we can see exactly what they are. So the answer to the question is we often drop the term rider after the 7th year because it reduces the cost and gives me more cash value. We can look at a cash value difference column here if we'd like. So all we would do is take our cash value from this example and subtract it from this example. And in the first 7 years, you will see no difference. But as time passes, you will see a difference. continues to compound over time, and we can drop all the way down. But without that term there, we're going to see it grow faster, which is nice. Now, the exception we mentioned on the whiteboard earlier was if I want to keep funding the policy. So here's the exact same policy, but what it looks like if I keep funding it, which I don't need to declare up front. So here we fund it for 15 years. We said, I want to keep going. We pump more money into it. We have more cash value, which is fantastic. But because we pumped more money into it, it pumped up our whole life death benefit, which brought down our term. So now by the time we stop pumping money into it, it's compounding. The dividends and interest that it's producing is growing the whole life death benefit, and that's naturally buying down the remaining term. There's not that much anyway, but as we scroll down, the term goes down to 0, and then I see my whole life death benefit begin to increase. And these are all after the fact changes too, or adjustments we make to the policy. It's not as if I have to choose exactly what I want to do up front, because people don't know. Like, life's going to happen, things are going to change for better, for worse. I want the flexibility to be able to adjust as time passes. So in conclusion, why does the death benefit drop after the 7th year? It's to reduce costs and maximize cash value growth. Remember that it is optional. If you see it on an illustration, it does not mean that is automatically going to happen. We would need to actually make that adjustment in year 8. Even if we planned for it and sent it to the insurance company, we still need to sign off on the paperwork to execute that change if it is what you want to do when that time comes. And then we do exactly what you just saw, review it to see what the numbers look like with and without keeping the term insurance. Hope you enjoyed this video. I'd love to know your thoughts. Please leave any comments below. You can DM me on LinkedIn if you'd like. You can also check out our website if you'd like more information like this and how we help people with their finances and cash value life insurance and a whole lot more. As always, I hope this helps.